Okay, welcome. You're here because, let's face it, you want the key info without getting totally bogged down, right?
Hmm.
You want to be smart with your investments, efficient. So today we're diving deep into something pretty powerful for real estate investors, the 1031 exchange.
That's right. It all stems from Section 181 of the IRS code.
Hmm.
And essentially, it lets you sell an investment property or, a business property
Right.
and then reinvest what you make the proceeds into a similar type of property while pushing off the capital gains taxes you'd normally owe right then.
Hitting the pause button on taxes when you sell. Okay, yeah, that definitely gets my attention. What are the sort of real world upsides here?
Well, the most immediate one is that tax deferral itself.
Mm-hmm.
You're postponing the capital gains tax. It's the tax on your profit, basically.
Right.
And something called depreciation recapture tax. You get to defer that too. So basically tax on the wear and tear deductions you took over the years.
Ah, okay. So that money, instead of going straight to the government after I sell, it just stays in my investment pot, ready to go again.
Exactly. And that feeds directly into the second major benefit, building wealth faster. It stands to reason, right?
Mm-hmm.
If you reinvest the entire amount from the sale, your portfolio just has more potential to grow quicker
Mm-hmm.
compared to, selling, paying tax, and then investing whatever's left.
It's like planting a bigger seed from the start, yeah. More capital working means potentially bigger returns later.
Precisely. That's the compounding effect in action. More equity going into the next property can mean more buying power.
Right.
Maybe letting you grab a better asset, something with more potential, which then hopefully appreciates more. It's a cycle, fueled by deferring those taxes.
Okay, now, this term like-kind property, I think a lot of people hear that and assume, okay, sell an apartment building, must buy another apartment building. But it's broader than that, isn't it?
It is, yeah. That like-kind definition, it actually gives you quite a bit of wiggle room. So, for instance, you could exchange, say, that apartment building for a commercial spot, like a small strip mall,
Mm-hmm.
or even swap vacant land for an office building. The key is that both properties have to be held for investment or business use.
Gotcha.
So it really lets investors pivot, adapt their holdings based on market shifts or just changing goals.
That sounds incredibly strategic for, like, long-term portfolio growth. Now, for this deep dive, we're drawing a lot from Realty Exchange Corporation, REC. They seem to be leaders in actually facilitating these exchanges. What makes having a facilitator like REC so important?
Yeah, it's interesting. What stands out is the level of expertise and, frankly, the personalized guidance a good facilitator offers.
Mm.
REC, for example, they talk a lot about their history,
Mm-hmm.
helping thousands of investors. They point to folks like Bill Horan, Carina professionals who've seen all sorts of, complex situations.
So it's not just paperwork pushing, because it could sound like that from the outside.
Oh, absolutely not. REC really emphasizes that they offer strategic thinking, education. They want to help you understand the why and how. Find creative solutions for your specific situation. It's about peace of mind, really. Knowing an expert's got your back, not just shuffling forms.
That makes a ton of sense, especially given how much could go wrong tax-wise if you mess it up.
Exactly. And they also stress full IRS compliance. That means really careful tracking things like your depreciation history,
Mm.
the original cost basis, the rollover details from previous exchanges maybe.
Wow.
It ensures everything's buttoned up for the long haul, which is vital if you plan on doing this more than once over, many years.
Because keeping all that straight yourself
Oh.
sounds like a potential nightmare.
It really can be.
Yeah.
And REC also talks about offering strategic insight, especially now. They mentioned, the potential for capital gains taxes to go up, maybe changes to estate tax rules,
Mm-hmm.
suggesting that maybe now is a pretty good time to think about an exchange. Property values are often high. Maybe interest rates are still relatively manageable.
So they're looking beyond just the immediate deal, thinking about the bigger picture, the timing.
Precisely. And one huge thing they stress to avoid what they call failed exchanges is planning ahead, like really ahead.
How so?
Specifically, having potential replacement properties already in mind, maybe even lined up, before you sell your current one. This is all because of that super strict 45-day identification window the IRS imposes.
45 days to lock down what you're going to buy? That sounds incredibly tight.
It is. It's a sprint. REC contrasts clients who are prepared, decisive,
Yeah.
they do well, but those who wait, who kind of dilly-dally, as they put it,
Right.
they risk running out of time, and suddenly, boom, you've got a big tax bill you weren't expecting. So
Mhm.
preparation is just crucial.
Okay, that's a really key point. So thinking about typical situations, When does a 1031 really shine for RDC's clients? What scenarios keep popping up?
Well, a few common ones. A
Yeah.
big one is the sell high, buy better play. Investors who've seen their property values shoot up, especially in a seller's market, they use a 1031 to basically take that appreciated capital and move it into something else. Maybe an asset with better cash flow or less day-to-day hassle, or maybe just stronger growth prospects in a different area.
Okay.
You see savvy investors looking at like demographic trends, new infrastructure projects, things that suggest future value. It's not just about selling high, it's about buying smart for the next phase.
That makes total sense. Capitalizing on a good sale to reposition smartly? What about getting cash out? Normally selling is how you free up capital,
Right.
but that triggers tax.
Right. So REC points to this really clever strategy.
Yeah.
Instead of taking boot, that's taxable cash or non-like kind stuff you might get in an exchange,
Got it.
the client reinvests 100% of the proceeds via the 1031, tax deferred. Then, and this is the neat part, they can immediately go into a cash out refinance on the new property they just bought.
Immediately, no waiting period.
Apparently no mandatory seasoning period. So you complete the tax deferred exchange, and then you tap into the equity of that new property through a normal refi. You get cash, but without the immediate tax hit from the original sale.
Wow. Okay, so defer the tax with the 1031, then borrow against the new equity right away. That is quite a maneuver.
And it's a way to get liquidity without busting the tax deferral on the sale itself. Another big area is inherited property and estate planning.
How does that work? Doesn't inheritance give you a step up in basis?
It usually does, yeah. Inheriting often resets the tax basis to the current market value, which can wipe out the taxable gain right there.
Okay.
But REC explains how people use 1031s proactively before inheritance as part of estate planning. The idea is to swap until they drop, as the saying goes.
Yeah.
Keep deferring gains throughout their lifetime via exchanges. This can potentially set things up much better for their heirs tax-wise. They might even use trusts alongside 1031s for more complex plans.
So it's a tool for today and for planning way down the road for the next generation even.
Absolutely. And they also touch on Section 1033 exchanges quickly. That's for forced sales, like eminent domain. The key difference they note there is the reinvestment window is usually longer, like 2 years or more.
All right.
And you don't need a qualified intermediary like you typically do for a 1031.
Good distinction to know. Now, who's actually using REC? Is it just massive developers? Or?
Oh, no, not at all. REC says they work with a really wide range of people. You've got your individual investors, maybe someone with a rental house, small apartment building, piece of land that's gone up in value.
Right.
Landlords looking to maybe swap into something easier to manage, like a N&N lease property. Estate planners, obviously.
Sure.
Builders, developers.
Yeah.
But also folks doing their very first exchange alongside seasoned pros.
So it really sounds like this strategy and REC's help could apply to a much broader slice of the investment world than maybe people realize.
Exactly. And REC's wrap-up really brings it home. They emphasize that their value is that blend legal compliance, deep tax knowledge, and practical real estate smarts, all brought together to help clients use this powerful strategy effectively.
Yeah, it really highlights why getting the right guide matters so much, especially with markets and tax rules always seeming to shift around.
That's the core message. They basically say, look, if you're even thinking about selling an investment property, calling them first could be really important. Understand the potential savings. See how a 1031 might drastically improve your financial outcome.
Okay, so boiling it down. This deep dive, leaning on REC's expertise, shows the 1031 exchange isn't just some tax loophole, it's a strategic lever. A way to reinvest smarter, build wealth faster, and maybe hit your long-term goals more efficiently.
Exactly. And it leaves you with a pretty important question, doesn't it? Especially thinking about potential tax changes down the road and where the market is now. How could being proactive with tax-deferred strategies like this actually reshape your long-term financial picture?
Yeah.
It's definitely something powerful to consider on your investment path.
Absolutely. Definitely gives you a lot to chew on. Thanks for digging into this with me today. Always good to unpack these kinds of financial tools.